CNBC-TV18, embarking on a quarter century of excellence.
Hello and welcome to Startup Street. I'm Ritu Singh, and with me Ashwati Mishra and Arundhati Ramanan. Here are the top headlines from the startup space. Social media platform ShareChat lays off 200 employees, or about 15% of its workforce. This as part of its strategic restructuring. Parent company Mohalla tells CNBC-TV18 the decision reflects the company's commitment to streamlining its cost base and achieving profitability within the next 4 to 6 quarters.
Ola Electric eyes a valuation of over $7 billion as it gears up to file the IPO papers this week. Experts question the valuation after Ola raised funds 2 months ago, valuing the company at $5.4 billion.
Finheart, an insurance platform for underserved groups, raises $3 million in a seed funding round led by Omnivore. With participation from Kettleborough VC, the startup will use the funds to scale operations, targets onboarding 1 crore customers by the end of next year.
Paytm plans to revamp its online wealth management services and hire over 50,000 salespeople to get more merchants on its network. This as it aims to hit profitability sooner than it targeted.
SoftBank's India operating partner Vikas Agnihotri has officially exited the technology-focused investment fund after 3 years, as per a report. He was, remember, instrumental in Paytm's public market debut.
EbixCash says India operations won't be impacted by bankruptcy proceedings in the US, says it has strong standalone financials and governance with its cash flows solely available for its own needs.
Well, those were the headlines from the startup world today, but on to our big story. The Reserve Bank of India has granted the payment aggregator license to a handful of companies, including Razorpay. Now, this license essentially allows companies to provide payment services for merchants by accepting payment instruments from customers on their behalf and act as an intermediary of sorts. Now, Razorpay was among one of the first few players to receive an in-principle note from RBI in July last year, but come December 2022, the regulator had requested Razorpay to pause onboarding new customers until it got the final nod, which it has now finally received. So a huge relief coming in for the company, and joining me now to discuss its implications is Razorpay's co-founder and CEO Harshal Mathur. Harshal, pleasure again having you on the show here on Startup Street. You know, from July last year when you got that in-principle nod for the license to December when RBI asked you to stop onboarding new customers, and fast forward to today when you finally have that go-ahead. It's been a financial and emotional roller coaster, I'm sure, for you. How relieved are you now, and how does life change?
Yeah, no, of course, it is a welcome move from RBI, and we have been looking forward to it for a while. The morale in the team is back and energized, and we have been awaiting this for some time. But there are certain regulatory processes that RBI has to follow before they give it. So we're glad we are here, and now we are fully licensed and authorized. So that allows us to offer our services even and allow the merchants to trust us even more than they used to before.
But you know, Harshal, from last year to now, what is your estimate of how much business you may have lost out to thanks to this 1-year delay in getting the license, and what was the impact on the P&L?
So the P&L impact of new merchants is generally limited because most of the new merchants coming in on board are small merchants, which takes some time to build up GMV or revenue. So that impact is actually quite limited. It is impact, but that we were able to manage by offering other services around, for example, around offline POS terminals, and on Razorpay X side, we still have a lot of other offerings that we were able to offer and manage some of that. But the biggest impact is, I'll say, is on the morale internally, because payments is our oldest and the place where we started. Online payments is where we started, and there are a large number of internet SMEs that we power and enable on a daily basis. So not being able to onboard them, the amount of complaints and pings and questions that we were getting from all of these small merchants who couldn't go live because we were not able to onboard them was very high, and it was our top priority to get them live and going as soon as we got this approval from RBI, and it will continue to be core focus area for us in the next couple of days.
That's right. I mean, payments is your core business. But, obviously there's some lost ground to cover in onboarding these new merchants onto the platform now that you have the license. Can you quickly give us a sense of your plan, how you're going to go about this? Is everything in place? And how many new merchants do you estimate you lost out on that you will now be able to add to your 10 million strong base?
Yeah, so on the overall basis, right, as soon as we got this news, the entire company has got into a war room mode to ensure that the merchants who have been waiting and wanting to go live with us don't have to wait any additional day now that the license is in place. So we've been reaching out to these merchants, getting all the formalities and compliances and KYC in place so that we can start taking them live as soon as possible. First set of merchants actually has already gone live, and the team is operating with the entire org is just coming together and making sure that we don't have to lose even one more day, because the holiday season is coming up. A lot of merchants will be busy. So we want to ensure that all of them can go live in the next 5-10 days and wait through the holiday season smoothly. In terms of numbers, there's a large number of merchants waiting. It's somewhere between 10 to 50,000 merchants have been in our funnel for last 1 year. But it's hard to estimate how many of them will actually go live. We hope all of them do, but I'm sure a lot of those merchants might have found alternates, might have moved to some alternate system. So they'll take some time to come back, but we are making all our efforts to ensure that most of them can come back to our platform and we can continue to serve them.
Well, yes, Harshal, I suppose some of them would have gone to your competitors who did have the license. But, now that you have this in place, to what extent is your revenue going to be boosted thanks to this? And, how does it change your overall revenue projections, say, for FY24?
Yes, as I said, the short-term impact of new merchants on revenue is quite limited, but long-term, yes, definitely. And I think we will be able to do a lot more stronger financial projections. I think this FY, the impact will be limited because 1 quarter is too low for any new merchant that goes live. It takes about 6 to 8 months to really start moving significant portion of volumes to us. So, but our next FY plans are definitely going to be a lot more aggressive. Over the years, Razorpay has consistently grown 50% plus, 50 to 60% year over year. We're quite confident now that this is back, we'll be able to maintain that pace of growth the way we have maintained in the last couple of years. But one interesting advantage that we are feeling happy about is that we are one of the first players to get this final license from RBI, which gives up, which will allow merchants to get some sort of trust and proof of compliance and safety with Razorpay, which will go a long way in allowing us to onboard and serving them better.
Well, RBI updates fortnightly its list of certified payment aggregators. So we'll see who else got lucky along with you. But, Harshal, before we let you go, I think the last time we spoke, you indicated that Razorpay's businesses were nearing break-even and you wanted that break-even target before you actually go public. Is this entire thing going to expedite that process? Any timelines you can share on how much sooner you expect to hit profitability?
Yeah, so it definitely gives us a lot more confidence on those plans. Without new merchant onboarding, of course, we have to make as additional revenues from existing base as well, which is not very easy. In terms of overall basis, as an org, we are aiming to be profitable on the entire org. Our payment business is almost breaking even, but on the entire org, we are targeting somewhere during the next FY. From an IPO perspective, we are still about 2 to 3 years away from an IPO, but we are preparing our plans for it.
All right, Harshal, always a pleasure speaking with you. Thanks very much for your time here on CNBC-TV18.
Thank you for hosting me.
Moving on, Agilita Sports, co-founded by Abhishek Ganguly, the former MD of Puma India, bagged 100 crore rupees from Nexus Venture Partners. This funding is aimed at developing a range of consumer brands in the sports, footwear and apparel sectors. The new funds are earmarked for boosting manufacturing capabilities and for launching new sportswear brands. Joining us now to discuss this further is Abhishek Ganguly, the co-founder of Agilita Sports. Abhishek, thank you so much for taking our time and being on Startup Street. From Puma to starting your own sportswear company, you're specializing in basically sportswear and athleisure. So talk to us about what you have on offer at Agilitas, and will you have your own brands or will you have other brands housed under one roof? Can you elaborate on these plans, please?
Well, Agilitas is a comprehensive platform and playing in sportswear, where the category is supposed to grow 4x in the next 7 to 8 years. And we will actually invest in right from manufacturing to R&D centers, to design creation, to managing brands, to retail. So it's a very comprehensive platform, right from manufacturing to retail. We have invested in manufacturing by acquiring India's largest sports footwear manufacturer, Mochico Shoes, a company which was set up 15 years ago. We acquired that in our first deal that we did. And now we will also be launching not one, but 2-3 brands playing into different kinds of price positioning, different brands with differentiated offering for the consumers, which will be launched in the due course of time. So like I mentioned, Agilitas will play right from manufacturing to retail.
You know, from manufacturing to retail, but the sportswear and athleisure market, it's a huge one, but it's dominated by big boys like Nike, Adidas, Puma, and the like, right? So how are you planning on taking on competition? What sets you apart?
Well, we're just not a brand platform, to be honest. With the first investment that we did, the acquisition that we did, we're actually, contract manufacturers of some of the best global brands like Adidas, Puma, Decathlon, Reebok, Skechers, Crocs, and the likes. So that's one part of our business, which, given that all these brands want to build their supply chain very local, get closer to the consumer, that is going to grow in the next 5-10 years. On the other side, there is a lot of white space. Today, if you see, India is like a pyramid of how the consumers are today, placed right from entry brands to mid brands to premium brands. And there is a lot of white space available. And that's where we will be launching brands. Now, not all of these brands will be a new brand, because we would also be having long-term license of existing global brands, which we will get to India. And also we are in the process of acquiring a couple of brands in the category.
Right. Can you tell us what these brands are that you're looking to acquire? Are you in talks with anyone?
Yes, we are. I'm not in a position to disclose right now. But again, like I mentioned, these are brands with existing recall, heritage. There is a very strong lineage of these brands, a very strong roster of designs, which we will, manufacture in India and distribute and retail. And that's one part of our brand business. And we are also into acquisition of existing Indian brands, because we feel that long term there has to be an aspirational sports brand out of India. Right. And that's also one of our key objectives that we have as a company.
All right. And coming to the fundraise, you've raised $12 million now. What do you plan to do with these funds? And also, how soon will we see your products in the market?
Well, our second round was 12 million. We had done a 52 million first round.
Right.
Overall, strongly believe that this category has very high barriers to entry, because you need to build manufacturing, product engine capabilities, to retail, to spend on brand building. So there is quite a bit of barrier to entry, and playing end to end will really put us in a great position. And that's why we really wanted to build up our resources. We will deploy this capital first and foremost to enhance the quality of the existing asset that we have, which is on manufacturing, because more and more brands would like to manufacture in India. And then we will deploy a lot of the capital on brand building, launching the brand on strong brand proposition at various price points, democratizing and penetrating the sportswear segment into India. And that's what we are going to do in the next couple of years.
All right. And so right now your focus is on India. Any plans to go global in the near future?
That's a good question. We strongly are of the opinion that if we build something very strong and viable, there is no reason that an Indian company in the sports space cannot go global. So definitely our vision is to be a global company. The timing has to be right. It might be 2-3 years down the line, but we definitely want to be a global company into the sportswear scene. It is the time where we believe an Indian sports company can have global ambitions.
All right, Abhishek, thank you so much for joining us on the show today. We're completely out of time, but we wish you all the best on this new journey that you're taking.
Thank you.
Well, with that, it's time for us to slip into a short break. But coming up, Burger Singh, QSR burger chain's valuations spike up as parent company receives fresh funds. We speak to the founder of Burger Singh, Kabirjeet Singh, on how they plan to grow their business from here on. We'll be back shortly. Stay tuned.
CNBC-TV18, embarking on a quarter century of excellence. CNBC-TV18, embarking on a quarter century of excellence.
Welcome back to Startup Street. QSR brand Burger Singh has secured an undisclosed amount in a pre-Series B funding round. elevating its valuation to $52 million. Now, this funding round was led by Turner Morrison with participation from Homage Ventures LLP, Office of Aditya Ghosh and existing investors. Now, to take us through the expansion plans of this made-in-India burger chain, joining me now is the founder of Burger Singh, Kabirjeet Singh. Kabir, welcome to Startup Street. Like I said earlier, Burger Singh is now valued at $52 million. So take us through the current business growth numbers. What is the top line looking like? And what kind of sales have you seen this year? And most importantly, what are your top performing cities?
Sure. Thank you for having me. We look like we're going to end the year roughly at about 130, 140 odd crores in top line. The store level economics look fairly good. We've got 150 stores, out of which 111 are live. Each store does about a 20% EBITDA and roughly about anything between 14 and 17 lakhs per store in revenues per month. A lot of the stores are in tier 2, tier 3 cities, and I think that's where most of the growth for us is going to come over the next 2 or 3 years. What I mean by that is, say about 111 stores live. Tier 1 cities should be anything between 36 and 39 stores. 47 odd stores in tier 2 cities, and 25, 27 stores in tier 3 cities.
All right. With the fresh funds raised, you've got some aggressive expansion plans, and they're not just about scaling up. You also want to innovate and evolve in the QSR space. Kabir, elaborate on how you plan to do this. Also talk to us about the Burger Singh Express model and how it is maximizing ROI.
Okay. If you think of a burger brand, you're thinking of 3,000, 4,000 square feet of space. That's what the bigger American boys do, right? Capex ranges anything from about 2.5 crores to about 4 odd crores. What we wanted to do was we wanted to kind of associate the brand more with a smaller format, because then it becomes a lot nimbler and you can go into smaller cities. Because you would notice the larger burger brands are concentrated on the bigger 20 cities of India because of their Capex requirement. Now, what the kiosk model does is it's 100 square feet, literally a box. It comes in like an IKEA box.
Okay.
You can install it, uninstall it. You can plug it into the wall and it's good to go. So it doesn't need any water connection. It doesn't need any drainage. It's a self-contained kind of a unit. What that does is in 100 square feet, your rental requirements go a lot lower.
Sure.
Your capex requirements go a lot lower, because in 100 square feet, you can build something like that in 25 lakhs. Now, in 25 lakhs, you can deploy these in airports, in metros, in hospitals, in universities. Pretty much like a vacuum cleaner, you can plug it into the wall.
All right.
We've started rollout with the Delhi Metro. We've got 6 stores live, 15 more in the pipeline.
Okay.
Each store does anything, say, between 10 and 12 lakhs worth of revenue from 100 square feet of space. Now, that makes it a really, really capital efficient model. Also, ROIs are great, because at 25 lakhs, you take 3 lakhs back in EBITDA, you've got a payback period of less than a year.
Absolutely.
Which is the second thing, ROI perspective, is that the location risk completely goes out, because the biggest problem with F&B is you go and invest in a location, the location doesn't work, you lose 50-60% of your capex is lost, can't remove anything. In this case, if the location doesn't work, you unbox you box it up, you put it behind a container and just move to the next.
All right. Like you said, you've got 150 plus stores across the country, and you claim this network makes Burger Singh the third largest burger chain in India, behind only 2 global giants in the space. Talk to us about your pan-India expansion strategy. Also, are you on track to close the financial year with $18 million in QSR sales?
Yeah, so let me address the $18 million first. I think we'd probably exceed that number with what is happening with the kiosk model rollout at Delhi metros. We're slightly ahead of expectation over there, but you don't know how the rest of the quarter goes, but we definitely in line to exceed that number. Our expansion, well, our expansion is kind of built on the supply chain. So we've got a few warehouses. We've got one in North India in Kundli. We've got one in Mehsana. We opened one in Cal not too long ago. And now we are going into the south of the country.
Yes.
With the warehouse outside Bangalore, which will pretty much take care of Hyderabad, Bangalore, and Chennai. And those are the 3-4 largest cities that we want to penetrate in the next 18-24
Okay,
months.
and what about global expansion? What are the plans there, and what is the global playbook, if you could quickly tell us?
If we play our cards right, we could probably see doing 2,000-3,000 stores in India itself with the new chaos model. And we'd like to stay focused on the Indian market, even though we've gone to London.
Yes.
But we'd like to stay away from an international expansion, because India is still a very, very large market. And with this leaner model, I think we can go a lot deeper compared to what anybody else has done.
All right. Unfortunately, Kabir, we've run out of time, but wish you the very best for your expansion plans. And once again, many thanks for joining us on Startup Street today.
Thank you very much.
With that, moving on, unicorns are like adolescents. They still have a lot to learn about cash flows, corporate governance. Well, that's the word coming in from Shailendra Singh, Managing Director at Peak 15 Partners. Speaking to Money Control's Chandra Shrikant, he advised startup founders to aim for consistent compounding growth similar to traditional large companies in India. At the Global AI Conclave held over the weekend, he added that India will be a major player in the AI race in the long term. Here's a slice of that conversation. Listen in.
Think of unicorns as adolescents. Their potential is sort of demonstrated, but they haven't yet built the full muscle, and they haven't gotten to enough of a steady cadence in life yet. They're yet to discover some things about the world. Okay, and many have yet to discover free cash flow. Many have yet to discover that there's no endless stream of capital raising and so on and so forth. Many have to discover that, hey, good governance will get you a better multiple in public markets, right? So again, coming back, look, I think for India, one of the things that could be unique, what my hope is, one of the things that could be unique is if we try to emulate the success of the TCS, the HDFC Bank, the Asian Paints, in our startup universe, where we can build these consistent compounding engines that can help build, enduring tech companies. And I think we'll, that should be our collective goal.
What chance does India have of being a defining player in this, AI wave? Because on the face of it, we are GPU poor. I mean, research and talent poor. So how do we compete? Can there be really interesting startups? I know you invested in Sarvam. I mean, can India be a defining player, and in what areas?
So first, I think, we are in the very early innings of AI. And while I'm not an expert, so, this is a real conversation. Earlier this year, I was at a global Sequoia offsite. This is prior to rebrand. And I was telling my colleagues in the US at that time, saying, hey, we'd love to learn from you guys, and what are you seeing in AI? What are you guys doing? And they were like, look, we don't know much either. Like, we're all learning together. So like, if you feel like you don't know much about AI, which is how I always feel, and it's possible some of you feel, the good news is it's so early and it's changing so fast that there's time to learn. Okay, and it's going to take several decades before it fully plays out. So I think if you take a sufficiently long-term view, I think it's inevitable. India will be a very major player in AI. Actually, I think all countries will be transformed with AI. There's no question. And I think, given the fact that we have an enormous developer population, and we have so many software engineers, so many startups and so on, we will definitely play a very important role. In the very near term, of course, we are behind. Like, if you compare the cutting edge innovation going on in Silicon Valley and where we're at today, but I think it's too early. And it is both real, and it also has a lot of hype.
Well, with that, it's a wrap on this edition of Startup Street. More news and updates coming up on the other side. Stay tuned.